welcome to the Monday Futures Market Outlook for March 5th, 2012. This is Patrick Serezna. For those of you that would like to try a complimentary membership to our eminisource.com trading room, please visit our website. As always, we start off with a chart of the US dollar index futures, and for the last couple of weeks or over a month, we've been observing the key support line around that 78.50 level. We suggested even that there could be a temporary drop down to even 77.50 if there was enough catalyst to do so. But nonetheless, the US dollar is finding support and reversed exactly at the levels where we felt that support line should come in. At this stage, the US dollar probably will make its way up toward the 80 level here, but will probably still come back for another retest along the downside, maybe down as little as the 79 level, but we anticipate that there still will be a little bit more further consolidation. At some juncture, we are going to be substantially bullish the US dollar. We believe that in the bigger picture, the US dollar index could go not only to the 83 level, but we could even see 85 or higher, but that would be something that would be like a 6-month target. What we're really trying to establish here in the next week or two is whether or not the US dollar here really does put in a short-term bottoming formation here, sort of a declining wedge formation that bullishly breaks on the upside, and we'll be observing that in the upcoming week. Next here, I want to take a look at the Euro FX futures, and we're observing here the inverse chart of the US dollar. The largest currency input variable in the dollar index is the euro, and so you can see that that rising, declining wedge formation on the dollar index is the same rising wedge here on the euro. At this stage, the euro has rejected off the 135 to 136 level where we were anticipating overhead resistance. We would not be surprised if the euro even came up for a double top retest of that 135, 136 zone up along the upside. So we're not substantially bearish the euro just yet, but we do believe that this is where there is substantial overhead resistance, and eventually the euro will have a breakdown from this level, and that's currently the foundation of our forecast. Next year, I want to take a look at the 30-year Treasury bond, and we're obviously looking at the far end of the yield curve here, and we've seen bonds that have really not given anything back. We still are at extremely low yields, but we are now directly testing that 140 to 141 support level, and at some juncture, we actually do believe that the 30-year Treasury bond will still correct even lower, potentially as low as the 134 to 135 level down below, and what we'll be watching is whether or not it can make that break in this current environment. If the whole stock market goes through a little bit of a corrective pattern, we could still even see those Treasury bonds go back to retest 143, 144 on the upside before they attempt a breakdown, but we still think that a short-term breakdown move is likely in the cards over the upcoming month or two. Next year, I want to take a look at copper futures, and one thing that we were observing is that whether or not there would be a failed rally attempt on this leg of this rally, and this is a very interesting juncture within this within the market, because here, as we approach these previous highs, this is where a double top could come in on the top of a retracement. And so if we in any way have any substantial breakdowns in copper from this level, it would start to support the idea that we could be seeing a substantial reversal in the prices of the commodity. If for whatever reason we did actually have a breakout to new highs, which is still possible at this point because we have no reversals down, we would be looking for substantial overhead resistance at the 410 to 420 level, very similar to what happened in gold, where it kind of broke to a higher high but hit its head on overhead resistance and then subsequently corrected very rapidly. That could happen, but at this stage we favor the scenario that we reject off of this $3.90 to $4 focal point. Next year, I want to take a look at crude oil. And crude oil had a little bit of a fake out and reversal on the upside. And really at this stage, this is still an overhead resistance level that we've been targeting on the upside of crude. There is no indication yet of a substantial reversal downwards, but at some point we will be looking for that. If we don't see any substantial breakdown below the 104 to 105 level, then we could still see oil push even up toward this upside target of 116 on the upside. So we're not ready to officially be calling an end to the crude oil rally, even though we've now had a couple rejections here. But so long as we hold above that 104 level on little pullbacks, then we could still see one more or two more thrusts higher. Overall, at some point we will be looking for a high in crude oil somewhere up there, and probably be looking for a substantial correction in crude oil, but that might take the entire month of March to develop. When we take a look at these gold futures, we were, even last week when it was bullishly pushing, we were suggesting that the 1800 level would act as a substantial overhead resistance that would reject it, and that would end up looking like a rising wedge formation. With a $100 reversal on Ben Bernanke's testimony, that really has now put in motion a bear move. At this stage, we could have short-term rallies that could even see 1750 on the upside, but really at this stage, unless there was a very fast and dramatic rally that got it back up into the 1800 level, then really you have to at this point distinctly be bearish gold. And so here, again, even if we have a short-term rally to 1750, any immediate rejections back down are probably going to be shorts on the downside. Probably by the summer, if not the fall, we could see gold even trading as low as 1400. But really at this stage, we just want to see whether or not the gold bears can keep the selling pressure sustained so that some new downside momentum develops. That brings me to want to take a look at the S&P 500. And when we pull up the weekly charts on the S&P 500 going back 3 decades, we can plot an 80-week moving average on there to depict the bull and bear market cycles that the market has gone through. Now, the 80-week moving average actually remained relatively upwards pointing, but we had a number of violations last year in going above and below that. Really at this stage, we continue to be above our 80-week moving average and attempting to break to new highs. That makes the primary big picture trend bullish, but we are on the short term looking for pullbacks, but there's no reason at this stage to be thinking that we're beginning a new bear market yet. Next year, I want to take a look at the S&P 500 E-mini futures contracts on the daily charts. And now we're now almost 60 days in a straight line rally that hasn't had a proper corrective pattern, which is now overdue. At some juncture, we anticipate a correction on the downside, but over the last couple of weeks, the market just continues to hold up along the highs and hasn't really been triggered for one of these downside corrections. One of the ways that we drew that on last week and we've been talking about is the fact that this market could continue to fight up along here, not really able to go higher, but not really ready to trigger lower either. This scenario we have seen, and we were making it one of the scenarios we could see. Really at this stage, it's getting very long in the tooth, and while again we may have a little bit of a rally to a higher high, and even there's always the chance of a small fake out move that could see 1390 on the upside and an immediate reversal back down. But really, at some point, it will be inevitable that the market corrects downwards. And when it does, we're going to be targeting the 1320 level for our first downside target. Now, a much deeper correction could see the 1280, 1290 level on the downside, but we don't necessarily believe the stock market even has to go down that low. Really, 1320 will be the level where we'll be watching for reversals, and if we get a good buying opportunity down there, that's where we'll start to accumulate. Just to make some key intermarket observations, right now on that US dollar we remain relatively neutral on the short term, but on the long term we are actually bullish that US dollar. In the same regard, the commodities, while things like oil can still spurt higher, and you can't rule out the possibility something like copper could still even make a short-term spurt higher, we are on the short-term neutral, but we are actually long-term bearish these commodities, and believe that once this has really finished running its course, that we should have some substantial corrective patterns in commodities. In the same regards with bonds, while they are at historically low yields, we do actually think that these bonds can and will probably over the upcoming months correct lower on the short term, but in fact we believe at some point these bonds will still push to higher highs at some point this year as yields will go to historically low levels, but again on the short term we don't believe bonds are heading in that bullish way. We still are looking for that correction downwards. On stocks, on the short term, we've now switched to a neutral stance because of this short-term correction potential. We may, on the short term, also turn bullish once a correction has occurred. In the longer term, we are neutral. We do think in the bigger picture there will be some substantial correction this year, which may make our longer-term outlook turn more bearish, but we want to leave it stated neutral because we don't really are not looking for a new sustained bear market at this juncture, so don't want to give that bias by suggesting a long-term bearish stance, so we'll leave that at neutral for now. That was your Monday Futures Market Outlook. Thank you for joining us.